I just got paid over $257 in dividends today from two of my top high-yield dividend stocks. That was $179 from HES Midstream, a high-yield, high-growth company that I've been adding to recently. That's ticker symbol HESM. And $77.45 from Enterprise Product Partners, ticker symbol EPD. These are both midstream oil and gas stocks with high dividend yields. EPD is a company I've owned since 2020, and I have a 130% total return so far. Despite it being the lowest value stock in my account, it's actually much larger in terms of dividend income. This company pays me over $309 a year, and it's been a great example of the dividend snowball effect at work. Every year I've been reinvesting my earned dividends, and that's added up to 43.1 shares derived from dividend reinvestment. We call these DRIP shares. So not only does that give me over $1,300 of increased portfolio value, but it helps increase my dividend income that I'm getting every quarter. In fact, $93 of these total annual dividends is directly attributable to those DRIP shares. And overall, reinvesting those dividends has boosted my dividend yield on cost by 4.78%. And from dividend growth and dividend reinvestment, my yield on initial dollars invested is now 15.76%. And here you can see every single dividend payment that EPD has ever paid me going all the way back to 2020. And the interesting thing is, since this $46 dividend payment in 2021, I haven't bought any more EPD shares outside of dividend reinvestment. And now let's grow into $77.45, which is a 68% increase. During this time, EPD has also grown their dividend payment. The 3-year compound annual growth rate is 4.69%. And they've actually started doing 2 increases a year every other quarter. Here you can see they just had a 1.87% increase, and prior to that, they had a 1.9% increase. And what I'm trying to emphasize here is really the impact of dividends, reinvesting dividends, and dividend growth. If you just look at the stock price with a lot of these dividend stocks, as an example, EPD, the returns don't seem that good. So I was buying it initially around an average cost of $20 a share, and the stock price is up to $31.92 now. That's about a 55% increase. But from reinvesting dividends, my total return is actually much higher. And dividends actually power a large percentage of the long-term compounding in the stock market. And you can't see that when you only look at stock price. And if we go back and look at the dividend history for EPD, the growth isn't even that impressive. The 5-year CAGR is only 4.14%. But I think I'll actually be able to replicate that snowball effect and actually outperform my EPD purchase with this new buy of HES Midstream. As you can tell, it's already a much larger position. It just paid me around $180 as a dividend. It's already north of $700 in annual dividend income. And I just passed a total value of $10,000 on the position. But what I like about HES Midstream is that the dividend yield is actually higher right now than EPD at 7.11%. And the dividend growth is much higher. The 5-year CAGR is 11%. And I think they'll be in this 5 to 10% dividend growth range for many years to come. So today I'm going to do an updated stock analysis on HES Midstream, explain what I think the dividend growth rate will be going forward. I'll even forecast out what the dividend snowball effect would be like for investing in HESM stock. That will include a forecast of my existing position with no new money added, plus a dollar cost averaging approach of investing $1,000 a month. And we'll be looking at what that total value would be and what the total annual dividends earned would be. If you stick around to the end of the video, I'll share my position on HESM stock and at what prices I plan to buy more. With that said, let's roll the intro and jump into this stock analysis. My name is Zach. This is Dividend Data. You should leave a like and subscribe to the channel if you enjoy the video. Throughout, I'll be using dividenddata.com, which is the best stock research tool for dividend investors. I just put out a major update that greatly expands our stocks available for research. We went from 8,000 to over 80,000 options. So that includes way more international stocks and a new custom view for ETFs and mutual funds. As an example here, we can go to this new global search bar, type in SCHD, click here, and it loads much better now, and there's a custom view for ETFs. So you can see the price chart, an overview of the fund and the expense ratio, its full dividend history, dividend growth rate, etc., as well as a look at each individual dividend payment and a historic chart of dividend yield. You can also get a look at the top holdings of that fund and the percentage that each stock represents. That's just scratching the surface of the new update for dividenddata.com. If you want to learn more, the link is in the description and pinned comment of the video. So with that said, let's jump back into my portfolio and take a look at HESM. So this is a quarterly dividend. It's currently earning me $719 a year in annual income. The current yield is 7.11%. Based on my cost basis, I have an 8.07% dividend yield on cost. I've already reinvested dividends once, earning me 3.2 shares. That brings my yield on cost plus drip to 8.18%. And I just earned my second dividend ever from HESM, which was $179.99. I reinvested that dividend, which should earn me about 4.3 more shares in the stock. The 5-year compound annual growth rate of the dividend is 11%. And this company has been increasing their dividend every single payment. That includes the most recent increase of 3.83%. And I've done my research on HESM, reading a lot of their quarterly reports and presentations, and they've been putting out that they are targeting 5% annual distribution growth. By the way, if you don't want to read all the reports, you can ask my AI analyst to summarize their earnings reports. And I asked, what is their target dividend growth rate? And it correctly pulled out that they're targeting 5% annual distribution growth. It also mentioned they're expecting to generate adjusted free cash flow between $725 and $775 million in 2025, which will more than target that 5% distribution growth. And that's why 2 quarters into fiscal 2025, they've already beaten that 5% target. And you know how I mentioned they're averaging 10% increases a year? Well, they've had that 5% target that entire time, and they continue to beat it year after year. And if we go and take a look at their earnings presentations, you can see that they've been targeting 5% increases all the way back since 2021. So that's really the baseline for increases. Here they added another 5%, another 6%, another 5%, another 3%. And right now they have that 5% base target all the way through fiscal 2027. And I'd expect it to continue after that. So this makes the company poised for a very strong dividend snowball effect. So I'm going to forecast just what my current position would compound into if I add no new money other than reinvesting dividends. By the way, if you want to use this calculator, I have a dividend calculator available on dividenddata.com. Link is in the description and pinned comment the video. You can use that one for free. So here I took a very conservative estimate since I'm projecting over 35 years. And I just used that baseline 5% target and an annual stock price increase of 7%, which is below even what the market does. So these $10,000 with these rather conservative estimates would have serious compounding. In 20 years, that'd be worth over $125,000, paying me well over $5,000 a year in annual dividends, giving me over a 50% dividend yield on cost. And again, with these higher yield stocks, reinvesting your dividends is so important to the compounding effect. As you can see, the total value difference would be $125K versus $40K if you don't reinvest your dividends. And that compounding effect only gets stronger the longer you let your dividends reinvest. As an example, in 35 years, you would have a total value of $639,000, which would be paying you annual dividends of $20.5 thousand. So based on these projections, you would be earning nearly double your initial investment every single year in dividends. And this is what I mean by the compounding effect. That income is going to purchase more shares of the company, which increases your future income. And that happens every step of the way, from $100 to $500 to $1,000 to $5,000. Now, I do want to emphasize here that this is just a projection. And when you're investing in stocks, you're investing in real businesses, and their performance depends on market conditions and how the managers actually operate those businesses. And Hess Midstream as a business has not even been around 35 years. So the real results may vary significantly, but this is just a projection to illustrate the power of long-term compounding. But let's say it was able to hit these targets over those years, and you had a more thorough investing strategy where you're investing, let's say, $1,000 a month into the stock. Well, the results would get kind of crazy. As you can see, we still have this huge gap between with reinvestment and without reinvesting your dividends. By year 10, you would have invested $120,000 in the stock, giving you a total value of $246,000, earning you $12.8 thousand a year in dividends. By year 20, that would be worth over $1 million with $240K invested in the stock, paying you $45.6K in annual dividends. And just 5 years later, that total value would grow to just under $2 million in total value, and your annual income would have grown to $75.6 thousand a year. And by year 35, we're up to $5.8 million with $186K in annual dividends earned. So is now a good time to buy HESM stock? The company's gone up quite a bit over the past couple months, although it's still below its all-time high of $44 a share. Well, let's try a couple methods of valuing HESM stock. We'll do the dividend discount model and a brief discount cash flow model. So again, this is another free tool we have on dividenddata.com. I'll put the link in the description and pinned comment. You can try the dividend discount model for a stock, which is basically forecasting all the future dividends a company will pay. And then it tries to calculate the present value of the stock using some discount rate, have it be some desired return or baseline you want to hit. Or you could use the risk-free rate of return as an example. So let's enter the current share price of $41.47, the annual dividend per share of $2.95, and let's just put in that base target of 5% dividend growth, even though they'll probably exceed that over the short term. And we'll leave 50 years as the default, although it doesn't change that much between 30 and 50. The point is that we're just projecting this over a long time. So if you're trying to hit a 10% annual return, that's what we're saying here with the discount rate of 10, then HESM stock would have a present value of $55.90 in order to hit that 10% return, which implies it's 25.81% undervalued. And typically when we're investing, you want to have a large margin of safety. That way, if long-term dividend growth maybe only is like 3 or 4, you'll still have a lot of wiggle room to get good returns. Let's say you wanted 13% annual returns. Well, in that case, the present value may only be $37. But if they average 6% dividend growth, then the company would still be undervalued. So I suggest you go and play around with this calculator for a little bit. We also have a discount cash flow calculator in the AI Analyst over on dividenddata.com. Just type in any stock and DCF calculator, scroll down, and you'll be able to use this interactive calculator and change the model to alter the output. In this case, the model defaulted to an implied share price of $51.75, which implies 24.28% upside from here. And that was projecting revenue growth of 11% in 2025, 10% in 2026, 7% in 2027, and 0 in 2028 and 2029. And this is pretty reasonable if you just look at the unlevered free cash flow growth over time. We've been averaging around $700 million recently, and this is projecting $860, $1 billion, $1 billion, $1 billion, $1 billion, $1 billion. And it's giving me this number based on a multiple of free cash flow of 8.28, which is around what it currently trades at. So really, whatever way you kind of crack the egg, HESM is a pretty reasonably valued stock right now. But this is only a brief look into valuing the stock. If I spend some time here, I'm sure there's many variables I would change to alter that calculation. So at what prices would I add to my HESM stock? Well, newsflash, I'm kind of buying right now. I'm dollar cost averaging in. I want to build up my stake in the company. The current share price is $41.47, and I actually only missed my next buy order on the company by 20 cents. And moving forward, I'll be adding to my stake in the high $30 range and low $40 range. And as time goes on, I'll probably slowly adjust that target up as long as the growth of distributions is backing up those increases. So I hope you enjoyed this deep dive into some of my top high yield dividend stocks. And actually tomorrow I have another similar high yield, high dividend growth stock, another midstream oil and gas company, which pays out. And that will actually be around a $230 dividend. And I've been buying a lot of that one as well. If you want to see my future portfolio updates and stock analysis videos, leave a like, comment, and subscribe to the channel. And with that said, I'll see you in the next video. Thanks for watching.